Welcome back, best ever listeners, to the Horizon Podcast. So this week, I'm going to do something new. This is fresh off the presses. In fact, it's based on an article I read this morning and a bunch of data that I've been working on, and it's completely different. I'm not going to talk about tariffs. I'm not going to talk about inflation I am going to talk about interest rates, but in a different way. So I read an article in the Wall Street Journal this morning that said President Trump is working on an executive order that would allow U.S. retirement plans like 401ks to invest in private market investments. For commercial real estate investors, this could change everything. I'm Chang, and I've been active in real estate investing most of my life. And since 2007, I've led the research and advisory services team at Marcus & Millichap, the leading commercial real estate brokerage company. Now, as I do every week, I must mention that I'm doing this podcast independently, and what I say on this show doesn't reflect the opinions or positions of Marcus & Millichap. Now, this isn't a done deal. And even if that executive order gets signed off, there are still some concerns about how this would play out and whether there would be a backlash over higher investment fees or greater risk as people move retirement money into these alternative investments. And in the article, it quotes Martin Small, the finance chief at BlackRock, and he said, we'll likely need to see litigation reform or at least some advice reform in the U.S. to add private market exposure. And that's in reference to private market exposure to these retirement accounts. But if this happens, and a portion of the $12.4 trillion of U.S. defined contribution plans goes into private market investments like real estate, it could drive an influx of capital into the commercial real estate market. Now, for those of you who listen regularly, a couple weeks ago, I did a podcast about how capital flows influence property values and commercial real estate development and how it can reshape the market, the investment climate, if you will. And I talked a little bit about Austin and Chicago and some other markets in that podcast. But this week, I'm going to talk about cap rates and why I believe the idea that cap rates are being driven by interest rates is at least partially wrong, if not completely wrong. In my opinion, cap rates are actually driven by capital flows. Now, interest rates and the spread between the cost of debt capital and the going in cap rates can influence the flow of capital. So I guess interest rates and cap rates, they're not completely disconnected, but I think the flow of capital itself is far more important to what happens with cap rates than the actual interest rates. And I'm going to give you a bunch of examples here. If you look back over time, the correlation between cap rates and interest rates is really not very good. One will go up and the other one's going down, or vice versa. So just as an example, and I'm going to talk a little bit about apartment cap rates here, but it holds true for other property types. From 2002 to 2006, the 10-year treasury increased from 4% to 4.6%, while the apartment cap rates fell from 7.9% to 5.8%. All right. So treasury rates were going up, interest rates were going up, and cap rates were going down by a lot. Then from 2006 to 2009, the 10-year treasury rate fell from 4.6 to 3.6%. And apartment cap rates went up from 5.8 to 7.6%. So from 02 to 06, the interest rates were going up, not a lot, but they were going up, and cap rates were coming down hard. Then from 06 to 09, the treasury rates were coming down fast, and cap rates were going up pretty aggressively. But from 2002 to 2006, the number of apartment transactions went up by 87%, going from 5,620 deals to 10,520 deals. The deals actually did peak in 2005, not 2006, but the trend still holds, and there was still enough capital flowing to move the numbers. And between 2006 to 2009, the number of deals fell from 10,520 to just 3,398, which was a 68% drop. So here you have this correlation that people believe is out there, that when interest rates go up, cap rates will go up. When interest rates go down, the cap rates will go down. But that doesn't hold. At least most of the time, or a lot of the time, it doesn't hold. But if you look back over time and you look at the capital flows, when there's more money coming into commercial real estate, when there's more transaction velocity, when there's more deal volume, and I'll point out, I use transaction count instead of dollar volume, because dollar volume can be thrown off by, mega deals, major portfolios, or entity level deals that can make that dollar volume look huge when the deal count really didn't move. So I'm using deal count instead of dollar volume in most of the examples I'm giving. But if you look at the capital flows, the number of transactions, when they go up, and when they go up consistently year over year, or when they go up dramatically, the cap rates go down. And when the flow of capital into real estate, or the transaction activity drops, the cap rates tend to go up. And interest rates may be moving wherever they are during that time. Another example, from 2020 to 2022, the interest rates went up from 1% to 3.6%, while the apartment cap rates fell from 5.2% to 4.7%. Those are apartment cap rates on average across the country. Meanwhile, the number of deals at that time went from 13,865 to 20,224. So between 2020 and 2022, interest rates were going up, but the cap rates were falling. And at the same time, the transaction activity, the volume of money coming into commercial real estate, the deal activity was going way up. And in 2021, 2022, we had record levels of transactions. So I think there's a much stronger correlation between cap rates and the amount of money investing in commercial real estate than there is between cap rates and interest rates. And if cap rates and interest rates were strongly correlated, as many people believe, then the spread between cap rates and interest rates wouldn't vary so much. In 2006, the spread between the 10-year treasury and the average apartment cap rate was 120 basis points. In 2009, the spread was 400 basis points. In 2011, the spread was 470 basis points, and it was 430 basis points in 2020. Today, the spread between the average apartment cap rate and the 10-year treasury is about 150 basis points. So what I'm saying here is that these things aren't moving together. Cap rates and interest rates are not moving together. That's why that spread opens up and narrows down over time, and they can move in opposite directions. So I'm not just talking about apartments here, and I'm not just cherry picking data. There's a whole bunch of data out there. You can look at it for yourself. If you shoot me a note on LinkedIn, I'll be happy to share some graphs and graphics with you that demonstrate these trends that I'm talking about. But I'm not just talking apartments. If you look at other property types, the trends hold the same pattern. The spreads are different, but you can see the same trend if you're looking at retail or office or industrial or even self-storage. Cap rates and interest rates just don't move together. It's not even like, if you displace it by time, there's no correlation. I've tried many different ways and it's just not there. So when, you look at it over the longer term, the other argument is that people say, well, yeah, they don't move in tandem, of course, but they trend together over time. And yes, over the last 30 years, they've both been going down. Interest rates and cap rates were going down for about 30 years. But I don't see that as a cause and effect. It's almost more of a coincidence. They're happening they're doing the same thing at the same time, not because they're being affected by each other directly, but they happen to be moving in the same direction for other reasons. So, that's my opinion. But I think that, again, if you look at the math, if you did a correlation study, the coincidence of these numbers is not high. So when I'm talking to investors, a lot of time, I'll be talking to somebody they're thinking about selling, and they say, well, I'm not going to sell right now. I'm waiting for interest rates to go down. And so the cap rates will go down, and then my property will be worth more. But that's a fallacy, in my opinion. That's based on their assumption that the cap rates will fall when the interest rates fall. But what they're really waiting for is actually they're waiting for a coincidence to happen, not a cause and effect. In the early 90s, interest rates fell and cap rates went up. Again in 1995, and again in 2008, and again in 2020. And of course, people will say that there were extenuating circumstances in 1995 and 2008 and in 2020. The RTC, the global financial crisis, the pandemic. But that's exactly my point. Those extenuating circumstances restrained the flow of capital into commercial real estate. That's why the cap rates went up, because there was less capital coming in here, not because of what was happening with the interest rates. So this correlation, I could drill down and I could dig into a lot of different property types and demonstrate the same trend over and over again. There's really a lot more to be said about the flow of capital into commercial real estate as it ebbs and flows, as it more comes in and less comes in. And yes, that may be influenced by what's happening with the interest rates, but it's not the only factor. In fact, there are a lot of other trends that are shaping this far beyond what's happening with the interest rates. So this brings me to the horizon and looking forward to what this means. So let me give you a couple baseline things. In 2021, there was about $937 billion in commercial real estate sales volume. And yes, I'm talking about sales volume, not deals right now. $937 billion in sales volume of commercial real estate in 2021. That was the most ever. Last year, there was about $523 billion of commercial real estate sales volume. And when I talk about volume, I'm only referencing commercial real estate transactions over $1 million. So last year, $523 billion. So what would happen? Think about this for a moment. This executive order, it gets signed. They work out the logistics. What would happen if just 5% of the $12.4 trillion in U.S. defined contribution plans came into commercial real estate next year? Heck, what if just 1% of all that money in those retirement accounts was moved into commercial real estate? A 1% change. That's actually $124 billion. $124 billion. If that just came into commercial real estate next year, what do you think would happen? Even if interest rates are flat, even if they're up a little bit, even if the 10-year treasury is at 5%, what do you think happens if $120 billion suddenly appears and gets funneled into commercial real estate? If you add $120 billion onto the $524 billion in sales volume last year, which was, by the way, considered a relatively slow year. It was below average, at least below the average I used from 2014 to 2019. You move 524 billion, you add another 124 billion, you're basically at about $650 billion of investment into commercial real estate, or that would be the deal flow or the dollar volume of flow. That would be the fourth strongest trade year on record, right behind 2019 when there was a volume of 660 billion. So we add in $124 billion, we get to 650 billion in trade volume, fourth strongest year on record. And so looking back, the last time there was a jump of $120 billion in commercial real estate sales volume was in 2015. And the overall average cap rate went down by 20 basis points from 2014 to 2015. The apartment cap rates went down 30 basis points. Retail went down 20 basis points. Office went down 20 basis points. Industrial cap rates went down 20 basis points. And by the way, from 2014 to 2015, interest rates were basically flat. So there was really no movement in interest rates. Yeah, they move around, but in general, if you take the year average and you go from 2014 to 2015, the interest rates were basically flat, but cap rates went down for the overall commercial real estate. If you kind of bundle everything together, they went down, I think, like 22 basis points. And so think about that for a minute. If this new policy goes into effect, and they figure out how to make it work, if some of the money in the retirement accounts is diverted into commercial real estate investments, what do you think would happen? What would happen with cap rates? Because I believe it would put downward pressure on cap rates almost regardless of what happens to interest rates. Yes, there are caveats there. Right. If interest rates were to jump up to 6% or 7% or something like that, that could really create some different movements. But assuming cap rates stay range bound, somewhere around 4.5% as they are now, even with the best going in cap rates being negative leverage, that influx of capital, in my opinion, would put downward pressure on cap rates. Cap rates may go down 20, 30 basis points. And if that happens, property values go up and your return on investment, your return on capital goes up dramatically because you're using leverage. And so thinking forward, looking at the horizon, where do you want your chips? Where do you want to place your bets if this is going to happen? I think the returns on commercial real estate would jump significantly. Just an opinion, not a guarantee, absolutely no guarantee. I can't even tell you for sure that this executive order will go through, or if it does go through, whether it will be implemented because of the challenges with legalities and so on and so forth. But if this sequence of events takes place, based on what's happened in the past, and as they always say in investments, past performance does not indicate future returns or whatever it is. My point is that where do you want to have your investments? And if you wait until this actually goes into effect, if you wait until the executive order is done and all of the funds have figured out how to make this work and the capital is flowing, you're just moving with the herd at that point. This is something you will want to be ahead of if you can. And remember, the institutions are going to focus on larger assets. I think we'll see a lot of that capital flow into apartments and industrial properties. Probably some office at this point because we're seeing a turn in the office market. We'll see some larger retail trades, not shopping malls, but retail centers, strip centers, grocery anchored centers, that type of thing. Maybe lifestyle centers, maybe power centers. you'll see the larger properties impacted first, because that's where the big capital funds, that's where the Apollo Group, and Goldman and BlackRock and all of the larger funds, they're not going to play around with the $10 million deals. They want 40, 50, 60, $80 million deals. That's where you're going to see the movement. And that's the one that's going to really have an impact. And so just thinking out loud, and I just looked at this morning, I just started putting all this data together today. But if you think about it, you're going to want to get ahead of that curve, because that's where you're going to maximize your returns. There is risk associated, guaranteed. This might not happen. But if it does, the moves could be significant. So there you go. That's my big idea for today. If you want to see some of the graphs and graphics of the data, shoot me a note on LinkedIn, John T. Chang. You can find me on LinkedIn. Just connect with me, shoot me a message. I'll be happy to share some of the information that I put together on this. But there you go, best ever listeners. I want to thank all of you for joining the Horizon podcast today. Of course, I will be back next Sunday and every Sunday with the real estate insights to help you understand what's really going on in commercial real estate. So I'll see you next week. And now you know why I always say, keep your eyes on the horizon.